Okay. All right. So good afternoon again, everyone. Hope everyone had a good lunch. We'll be looking to start, where this is the first time we're doing it across two platforms, both Zoom and YouTube. So, we encourage all to send their questions as we walk through this presentation. Again, my name is Haughton Richards, Investment Management Associate at Cygnus Capital. Today, I'll be joined by Jason Morris, our CIO and co-founder, as well as David Cummings, who's the Vice President and Head of Real Estate and Project Finance. So I'll allow you guys to familiarize yourself with the platform. There's a Q&A section. We'll be able to answer any questions that are sent towards the end of the presentation. I encourage you guys to write down your questions as we go through the actual earnings call. And then towards the end, we'll have both Jason and David just answer some questions that may arise throughout the presentation. Jason, you're here with us?
Hi, good afternoon. Yes, I'm here.
All right, no problem. So Jason, you can walk us through today's earnings presentation.
Okay, good afternoon, everyone. A sec. As is customary, this earnings call does not represent the fulsomeness of the quarterly report, because the quarterly report is actually on the Jamaica Stock Exchange's website, as well as on the Cygnus Real Estate Finance website, which can be found by going to cygnusgroup.com, scrolling to Cygnus Real Estate Finance, and you will see the full earnings report there. All right, you can move on. All right, just to start out this conversation by speaking about the major achievements that SRF would have accomplished over the first 9 months since becoming a listed company. So the first key milestone is 30%, and that represents the One Belmont development, which is a 9-story commercial tower. Its completion rate currently at 30% and remains on track to be completed next year, April/May. So that project is, a very large project for SRF. $3.7 billion, and the project remains on track, and I'm sure that David can give more insight on that later on in the presentation. Second thing I want to highlight is Spanish Pennywood industrial facility, which is 100% tenanted. Well, it's not completed yet, so technically it's not tenanted as yet, but lease agreement with the tenant has been signed. It's a US dollar lease. We would have received half of the sale price for the asset, meaning effectively SRF has already de-risked this asset already by selling it off to pension funds, and would have received half of that money to date, with the remaining half to be received once the construction is completed. So 2 projects that SRF has deployed equity capital in, going quite well. Third thing has to do with the Mumbai Bay investment property. So last time we would have told you, and David would have gone into some detail on this as well, that we were moving through the design phase, and we had intended to complete that by the end of May/June. And now that we're in July with this report, we can confirm that we completed the design phase, and we are now moving into what we are calling the hospitality phase, or the execution phase rather, which is effectively over the next 60 days to take a decision or execute a decision, either to sell the investment property with all the plans that we have for it, or to execute those plans ourselves. So we'll give you a lot more information once we are closer to that time, or we have actually executed on that. Fourth thing rather, is just speaking to, SRF is still in the very early innings of its investment life cycle. And so what would have committed to shareholders and on this call last time was that we are moving, substantially increasing the amount of the assets that we have that is generated income. So we would have more than doubled those assets from about 1.1 billion to 2.38 billion at the end of the reporting period, which is a substantial increase, even though we are still not at a level of investment in income earning asset. And by income earning asset, I'm speaking to real estate investment notes, which is a unique investment strategy created by Cygnus Real Estate Finance to generate income, which is slightly different from investing in a completed building, for example, and generating lease income. The fifth and final thing that we want to focus on, obviously SRF has been investing now for a while. We still haven't gone through one full cycle of investment as yet. Our average investment horizon is 3 to 5 years, but we are coming up on the first investment horizon, complete life cycle. So we have about at least $2 billion in investments that are at various stages of advanced execution, and we will be looking to exit from those over the next 6 months. So just want to highlight that these are kind of the key things that SRF has been working on since the start of the financial year and over the last 3 months. Now, looking at the performance of the financial statements, first starting with the 9 months, total investment income was 60.2 million compared to over 2.3 billion for the similar period last year. And again, as we would have said in the last call, SRF's revenues will remain lumpy for some time yet, primarily because it's still going through the early phase of its investment life cycle. One, and two, SRF reports in Jamaican dollars. It has vast majority of its real estate assets are actually US dollar investments. However, from an accounting treatment point of view, real estate assets are not marked to market, meaning every quarter you do not go and do a valuation of them. So you don't have a valuation change coming through the income statement, and obviously you don't have an FX change coming through the income statement either. The only time you get that movement is at the end of the financial year when we update our valuation reports. So that's the rationale behind 60.2, which looks it's relatively low. It's low relative to last year. The other thing that's happening here is that the timing of SRF actually unlocking value from its real estate assets will vary. So for example, the one Belmont project that we are doing, you're not gonna see any of that flowing through the income statement in terms of the impact in the profit and loss until we are almost at the back end of the project. And likewise with pretty much all of the development projects. So last year we would have had some exits from investments that we would have done, and which unlocked substantial value for our shareholders at that time, and that would have resulted in a substantially higher total investment income or top line revenue. Moving on to net investment income, registering a loss of 212 million versus a gain of 2.19 billion last year. Again, the reason why we would have moved from 60.2 million in total investment income to a loss of 212 million has to do with operating expenses, which because the company is not yet at full steady state in terms of generating enough interest income to cover operating expenses as reported on a quarterly basis, then this is what has generated that loss. When we get to the financial year end, however, and you bring into the financial year end the changes in the valuation of the vast sums that are being carried on the balance sheet, then we would expect a reversal of what we are seeing here. So overall, net profit came out at our net loss of 197.5 million versus 2.28 billion in net profits last year, which would have triggered a basic earnings per share of negative 0.63 cents or a loss per share of 63 cents. and a diluted earnings per share, diluted loss per share of 59 cents versus last year's basic earnings per share of $12.78, and which is the same as the diluted earnings per share last year. Shareholders' equity, $6.7 billion relative to $5.18 billion for the same period last year. And of course, the increase in shareholders' equity would have been as a result of new capital that was raised in the IPO last year, as well as profits that would have been generated at the end of the financial year last year. So overall, book value per share is $21.54 versus $29.23. And the big difference in the book value from the similar period last year to this year has to do with the approximate 128.4 million in new shares that were issued during the IPO. You can go to the next slide. So similar to the 9-month period for the quarter, total investment income, 29.6 million. And I want to highlight here that if you look at the main driver of total investment income at the moment, which is net interest income, that would have increased substantially. Of course, the percentage increase in net investment income of 325% is nowhere close in terms of steady state where we want to get to. And we'll get there as we go through our investment life cycle. Net investment income, a loss of 65 million versus 1.27 billion last year in net profit. And overall, net loss per share, net loss is 72.7 million, which came out to a basic earnings per share, a loss per share of 22 cents, and a diluted earnings per share of 21 cents, versus net profits last year of 1.28 billion and basic EPS of $6.79, same as the diluted EPS. And of course, shareholders' equity and book value per share remain the same as it was, as it is for the 9-month reporting quarter. 9-month reporting period, sorry. Next slide. So in terms of investment activity, the company now has a record 11.06 billion in real estate investment assets versus 7.25 billion in the same period last year. And this primarily being driven by a combination of new acquisitions, deploying more capital into real estate investment notes, and acquiring some small strategic investment assets. As far as the total balance sheet, total assets 11.68 billion, also a record, versus 7.39 billion for the similar period last year. Real estate investment notes 2.38 billion, that's also a record, versus 1.1 billion last year. New investment commitments would have deployed 2.42 billion versus 619 million for the same period last year. And dry powder on the balance sheet, 545.9 million versus 50 million for the same period last year. Of course, the dry powder that we're speaking about here, which is the excess cash that SRF has to invest, does not include 2.5 billion Jamaican dollars in undrawn construction loans, and it also does not include undrawn revolving facilities and undrawn bridge facilities, which will only be tapped once there's a need to do so. In terms of investment allocation, no major changes from last quarter to this quarter. Majority of the portfolio from a investment category allocation point of view is in investment property, more than 2/3. And this is primarily being driven by the fact that the company has, just started investing a little over 2 years now. And its strategy would have been to build up a quote-unquote land bank with key strategic assets that it would then monetize over time. So that's the reason why that's the main allocation. And of course, real estate investment notes being the second largest category, which are the income investing assets. And from a real estate category, we can see where hospitality, which includes the Mumbai property, is at 32%, and industrial, which includes Lakespin property, is a close second. Next. So now to give you some insights in some of the major projects, and I will kick it off and then allow David to give you some more insight. So David, if you may just very briefly give some insight into the major projects.
Sure. Thanks, Jason, and good afternoon, everyone. So you're seeing on screen now the Spanish Pennywood project, which is an industrial project along Spanish Town Road, the corner with Pennywood Avenue. The update here is that we are pretty much at 50% of just under a shade under 50% completion in the construction of the project to hand it over to the owners. The project is going well. We have, as you can see there, we have already executed the 10-year lease, which is renewable for further 10 years. And we're not anticipating any major issues at all with this based on where we are in the execution. The contractor is performing and we are on track for completion as shown here on screen. Yeah? Next one. This is 1 Belmont, the commercial property, 1-3 Belmont Road. It's pretty much a 4-story parking garage with a 5-story Class A office sitting on top of it. So very, very advanced design. And you can see here we're pretty much at 30% completion, and we're on target for the completion of this project here in April, May of next year. Again, the contractor is performing. There are no major issues. We have done a lot of things to mitigate various risks that have arisen in the market over the last year. And as you can see there, 3 of the 5 floors have already been executed in leases, with, of course, ongoing discussions with additional blue chip tenants currently underway. Next one. So this is the hospitality project at Miami Bay, which Jason spoke about. We have assembled a formidable team of international partners who are all very experienced in delivering ultra-luxury projects, not just in the USA, but on islands and in unique locations across the world. So as Jason said, we are in that decision window within the next 60 days that we'll be making the decision ultimately where we go with this particular project. Certainly, but in terms of what we have designed, depending on which way the decision goes, we look forward to giving you further updates as to where we will go with the Miami Bay project. Next slide. This is the industrial project, Lake Spen, 55 acres. And again, we have already assembled another formidable team of international consultants to help us to advance how we'll unlock the most value from this particular property here. We're quite advanced in the feasibility study and in the process of the designs. And again, this is another one of the projects that we will be approaching a decision window before too long. This is the former French embassy, which, as you can see, we did some minor renovations and executed a short-term lease with a strategic client. So it is now in use. And whilst this is currently out on the short-term lease, we are continuing the planning work with our strategic partners just to see what's the best way that we will unlock the value, because this is 3.2 acres in Kingston 6. So it is a very, very strategic location. And as you will be aware, there are parts of the property that are zoned for commercial, some are zoned for residential. So we have quite a bit of flexibility in how we'll be able to unlock the most value from this particular real estate asset. So thanks very much. I'll hand back to, oh, sorry, I thought that was this is the rain here. This is the Surrealistic sugar mill in Montego Bay. We expect to be at practical completion in a matter of weeks. on this particular project. As you can see here, this is actually a few weeks old on a photograph, but certainly we are approaching practical completion of this one within a few weeks' time. It comprises 24 apartments and 2 townhouses. On the left picture, you can see one of the townhouses on the left. The other townhouse is on the other end, over the far end of the picture out of the photograph. But as you can see, pretty much this is a practical completion. So we will be wrapping up this particular project in the very near future. Next one is Ocean's Edge. This is in Discovery Bay. This one is a little bit behind from where Surrealistic at the sugar mill is, but Ocean's Edge is 16 luxury seaside townhomes, and currently we are forecasting this will be at practical completion in about 4 months from now. The project is going well, has had a few challenges, but certainly we are expecting, based on the where our sales is practically sold out, we expect that we're wrapping up to practical completion of these units very shortly. And the next one is Norfolk Wausau. Again, this one is nearing practical completion. Some minor delays with some shipping of components, some final finishing material, as has been plaguing the entire industry. But we are not far away from practical completion, but for the arrival of some of the final finishes. And again, these are 6 of 8 units already sold with indicative offers for the last 2 units. The project is going very well. Contract is performing, and we expect that these apartments will be handed over to the new owners within the coming months.
Okay, so thanks, David. So just to spend a few minutes to give our thoughts on some of the pressing matters that would have occurred between the last report and this one. Obviously, you know, home prices are residential. The prices in the residential market space has, you know, skyrocketed in every major city in the world, and of course, Jamaica is no exception. But what this chart is doing, it's showing you, it's an index, which is basically capturing, you know, the price of a house relative to the median income. And you can see on your right that we pretty much have a, you know, what looks like a certainly steeper than 45-degree angle going up. And the last time that we had that, we knew what happened afterwards. So in other words, this is an indicator of affordability in the housing market. We all know what's causing the prices to go up, but at some point, you know, this can't continue forever. So we are watching these indicators, and we're looking at, you know, a lot more data than just this, but just want to put this at the forefront of the minds of shareholders, that we are absolutely clued up about the various factors that can impact the housing market. Jamaica doesn't really have a lot of data, but so you can't really create a graph like this per se for Jamaica. But, you know, when we look at what's happening with all of the major cities around the world and what's happening with prices, we get a good sense as to, you know, what you can utilize as a leading indicator when things are starting to turn up. Next slide. This is looking at steel prices, going back a little bit over a decade. At the start of the year, steel prices would have, you know, flown the coop, so to speak. But since that time, since, you know, accelerating rapidly, steel prices have actually come off the boil. They are actually down 40% since peaking in March, and down just another about 36% year to date. Of course, at the same time, when you look at where the prices are currently versus last year, still up call it 60%, right? 55%. So this can give you some context in terms of, okay, the prices have come off, which I guess makes it a little bit more affordable for those who are doing construction. but at the same time, it's very elevated because it's still, 50% or more relative to what it was in December 2019. In December 2019, which is kind of a pre-COVID marker period. Next. And same thing for lumber, another key input. I mean, started off the year on fire. You can see by the what looks like the mountains and the graph, how steep and how fast the price escalation was. But lumber prices are now down 55% from the record highs in March, and down 42% since the start of this year. So again, bringing back the affordability of some of the construction inputs. But if you look at it versus last year, still up, well, versus 2019, which is kind of a pre-COVID marker, it's up 61%, right? So it means that the price of inputs are elevated, although the prices since the start of the year have kind of, I wouldn't say normalized, but they have come off the boil, so to speak. So again, just providing some context. Next. So finally, in terms of the sector outlook, we maintain the same outlook that we had from the last period. Obviously, there are a lot of moving parts on the industrial side. We are constructively bullish. We think that where warehouses and logistics are concerned, the demand for this type of asset is still very, very strong, especially given supply chain issues that we have been experiencing. And in Jamaica in particular, there's only so much land that is located close to the highways and to the ports that you can have. No more of those lands aren't being made. And we have 55 acres of it. And so we have a grand design in terms of what we intend to do to unlock value with that. So we are bullish there. Hospitality took some hits during COVID, but I guess everyone in Jamaica now knows Jamaica is the leading destination in the region in terms of leading recovery for tourism. And we are like the #1 destination in the Caribbean. And that has not changed with the recovery that has been ongoing. If you try to book a hotel or a villa or anything on the North Coast over between now and December, good luck if you're just going to do it now, right? So the demand is ridiculous. But on a longer term, over a longer period of time, what we have learned is that the luxury segment of hospitality is kind of inelastic to economic shocks. So we remain very bullish on that front, and that's where the substantial portion of SRF's investment assets are in the hospitality sector, is on the luxury side. As far as residential, we are bullish on various segments of residential, but overall on this segment, we are tending towards neutral. And that has to do with the fact that, we just showed you the chart about house price to income, which is an affordability kind of index. And ultimately, if prices continue rising, then at some point, something will have to give, right? And then you have the demand supply picture. And there are some segments of the market that might be oversupplied and other segments that has maybe a 10-year supply backlog, which we know, that's not going to get corrected anytime soon. So we are bullish on certain segments. If you have anything that's close to the sea, people can see the water, hear the water, then those fly off the shelves because the clientele who are going after those are primarily going to be diaspora clients, etc. And versus, let's say, apartment complexes, which are very, supply versus demand dynamics again, versus say townhouses or detached units. So we think that, we are positioned for whatever may come, but we think that we are more neutral on the residential side, which does not mean that we expect prices to fall. It just may mean that maybe the 30-20% increases that we have been seeing with some of the prices, that percentage increase may slow down to maybe 10-5. Doesn't mean that prices are gonna are gonna come back. Just means that the dynamics there with interest rates going up could affect some segments of the market, although that remains to be seen. And then finally, commercial, just focusing on Kingston, there's absolutely no supply. There hasn't been any supply for maybe 2 decades. And so that's the reason why we are bullish. And that's where our assets, or all our assets are. Not retail, but more so corporate grade A space. So that's it in a summary. And, we're now open to take any questions that you may have.
So thank you for that walkthrough, Jason. So a couple of questions both on Zoom and on YouTube. So I'll just take one from the YouTube first. One of the first questions is, how does the expected outlook for housing prices impact SRF?
Good question. So, I mean, it will impact SRF through, I guess, 2 different channels. The real estate notes are the reams that David would have gone through, which are primarily the residential assets that we have. Those are our third-party assets, and we fund those using real estate investment notes, which are fixed income debt financing instruments, and in some cases, we take a share of profit. So we are not overly exposed to residential at the moment. I mean, majority of our assets are actually in commercial and hospitality and industrial, with a few sprinkling in residential. So it wouldn't really affect us substantially, but even in the cases or instances where we take exposure to residential, those are very strategic. As you can see, we have an 8-unit luxury, we have a 28-unit upscale luxury, and we have a 16-unit townhouse. And all of those are strategically positioned and marketed as such, and don't really have a problem selling. So we don't think that will be substantially impacted if there were to be a correction. But we are well diversified across all the major segments of real estate in any event. But to answer your question directly, we don't think that there will be a huge impact just because of the way in which we have structured our exposure through real estate investment notes versus having any substantial exposure ourselves.
All right, thanks for that, Jason. So a couple of questions here on the side of Zoom. One of the first questions is, what is the progress on the $720 million private placement raise that SRF is currently undergoing?
So that's going well. I don't remember what the number is at the moment in terms of the indicative book. I think we intend to close that transaction at the end of the month. So that capital raise is ongoing and is going well. And we expect to get the amount of money that we want. It's actually 480 million upsizable to 720, just to be specific.
All right, thanks for that. So an additional question that came would have been the 736.73 million asset held for sale. Is that related to the Spanish Spinwood sale?
That is correct. So basically, it was investment property, and because we are so close to completion, it has been reclassified to asset held for sale, especially given the fact that we have received half of the proceeds from the pension funds who bought the asset with the tenant, the lease.
Okay, so an additional question that came in was in the context of Monad Royce. It was the individual says referred in the financials, but is there any additional information that could be shared?
So let's just say that it's located in the middle of the Golden Triangle. And that project is going to be a residential, upscale, and very few, not a big thing, a very select, high-end upscale project that we think will do very well based on the clientele that it will go after and the type of development that it will be, in terms of it's not going to be like a large apartment complex or anything like that. So, but that's all I will say at the moment. I'm not sure if David want to say anything, want to add any color.
Well, I guess one other thing to add with that, it's a joint venture. So, but yeah, we're in the early planning cycle of that. So as you will appreciate, there is a gestation period that we need to go through, or the final due diligence with the design brief, and then go through the approval process. So once we are at the stage where things are more definitive, then we will be able to release you more details of that particular project.
All right, thanks for that, guys. So the additional question that came in is respect to the REINs. It is observed that the fair values or the fair value of the income statement is impacted by adverse interest rate movements. As it is the case that are the REINs fixed rate or variable rate, which positively benefits SRF when rates increase, or are they protected to the downside? So this question is more about the structure of the REINs in terms of that fair, how does the interest rate movement impact them?
Right, good question. So basically, you have two sets of REINs, right? You have REINs that are just a note with a fixed coupon, and those are carried at amortized cost. And then you have REINs that are a fixed coupon, and then you have a share of profit. So because you have a share of profit and the profit is uncertain, then that uncertain portion of the REIN means that you have to fair value the entire investment and bring it through P&L. So if interest rates move up or they move down, that affects the value of the REIN. So that's how that pretty much flows, until, of course, when you get to completion date, and then you exit at whatever, get back your coupon plus whatever profit the project would have generated. But during the interim, you have to market, so to speak. And if rates jump up or they go down, it causes the value to fluctuate. So the way how this is built, of course, is on the downside in terms of protection, obviously, they are all they are over collateralized because the investment exposure is being covered more than one-to-one by the value of the underlying project, right? So that's how we get downside protection. And an upside basically is the project makes a profit, and we don't go into any project not to make a profit, obviously, then that's how we get the upside. And that upside is what is causing the fluctuation in the pricing based on interest rate, just due to the accounting treatment of the asset.
All right, thanks for that. One question I think this one towards David is pertaining to the Ocean Edge project. Is there a drag on the project that would have caused it to not have been completed earlier?
Yeah, thanks for that question. So it's not a single reason why there has been a delay here. There are some supply chain related delays with some of the components. For example, the hurricane rated windows have had a delay because of issues at the factory. There's been a COVID related delay, as well as there's been a technical delay with one aspect of it, which have all been corrected now. So it's no one issue itself that has led to the delays, but we have managed to mitigate and overcome those issues, and so we are going to be closing out this project in the months ahead. So it's not any single issue; it's a combination of factors.
All right, thanks for that, David. There is one question pertaining to the eventual payment of the management and performance fees, which are currently ranked as payables. Is there a proposed payment schedule to actually pay these outstanding payables when they become due?
Yeah, so effectively, the way how those performance fees are going to be paid, there's a strategy that's being utilized to, which is non-cash. Is that you utilizing a strategy that doesn't necessarily use cash to pay those fees. So that's how that is being handled, rather than utilizing cash, you use other payment in kind.
Thanks for that. And I guess one more question, which is really pertaining to what are the likely impacts to SRF given the rise in interest rates in terms of the needs to borrow capital? And on the flip side, does SRF also benefit from the rising rates given that it's a financing company?
Yeah, good question. So it obviously cost of capital will go up. And so in terms of accessing cheap financing, SRF will obviously be impacted by a higher cost of capital. But because we have a substantial portfolio that is focused on investing in a manner that generates income, then we pretty much just maintain our spread, our margin, right? Because as the cost of capital goes up, our cost of financing will also go up to those who so the projects that we are financing, we are putting in debt financing and using means to finance it. And so that's a bridge that we will basically create to just maintain. If our spread is 500 basis points or 400 or whatever it is, then we do that. So that's one way that we solve that problem. The second thing though is, we are looking at what I should say external financing that will come at a substantially cheaper rate that will allow SRF to pretty much have a lot of flexibility in terms of what it can do, so that in a situation where rates are rising and the cost of financing is rising, SRF can be very nimble in terms of it can either increase its cost that it finance projects at, or it can simply absorb some of that, but then take the flexibility and the upside and the profit sharing portion of the notes for projects that are structured, are done properly, that minimize the risk of losing opportunity cost and the share of profit portion. So give you an example. If you have a note that is, let's say, 10% coupon, and then you have, let's say, 25% share of profit, just because of how development is structured, then maybe, we can structure it such that that 25% share of profit becomes more certain with a lower threshold level. So as we move through time, the project is not being burdened by having higher interest expense, but majority of that is structured at the back end, where when the project is completed, we have a payment in kind that comes out at the back end. So there are multiple ways that we can mitigate against higher interest expenses, higher interest cost. But generally speaking, if interest rates are going up and SRF is in the market looking to borrow money, its cost is also going to rise. Just a question of how we maintain that margin between our borrowing cost and what we unlend to, or what we invest out at.
Okay, so I'll just take two more questions. One from YouTube. The question is, you seem to be pulling back from Mumbai Bay. Why? I think this is in relation to the graph, but I mean, we can expound a little bit further.
I guess I'll let David take some of this later, but I'm not sure what is meant by we are pulling back from Mumbai Bay. I think last time we reported, so the valuation, so we have Mumbai Bay at a current value of, I think, 3.59 billion. It's, you could call it the crown jewel in SRF's real estate portfolio. David and the team has done a tremendous amount of work on this. We are now moving into the decision phase, and we just don't want to make a lot of noise before the decision has been taken. But rest assured that Mumbai Bay, whether we sell the asset with the development plans or we execute the development ourselves, and that a decision to be made. It's absolutely a phenomenal value creator for us. It will be a phenomenal value creator for SRF. I don't think there's anything like this in the Caribbean, let alone Jamaica. So in the next 60 days or so, all of that will be revealed. I think there were some hint at some of what maybe coming in a news release that was that occurred earlier during the year. But hey, we're definitely not pulling back from Miami Bay. I'm not sure if I'm misunderstanding the question. We're not pulling back from Miami Bay. It's full speed ahead, and it is going to be a substantial. When we speak about unlocking value from real estate asset, this asset is going to demonstrate what we mean by that.
All right, thanks for that. So the final question we'll take for this session is, with the expected 2 billion exit, will these funds be going to ongoing projects or to new projects?
So it will be a combination of both. Remember that in real estate, you don't deploy all the capital at one time. If you have money and you have a project, you have a drawdown schedule, and then the money trickles out. But it might also be a situation where, as we exit certain assets, we need to replenish them. So if we are exiting real estate investment notes, for example, then we need to find new projects that are structured as real estate investment notes. As we get close to exiting one Belmont, for example, which is slated to finish in early to mid next year, then obviously we need to have another commercial project that we are rolling onto the books, so that we have a consistent pipeline of projects that are turning over. So it all depends on the timing of those projects and the timing of new opportunities that may arise. We're also looking at opportunities in new markets. I think we have the real estate team has visited a number of projects in other markets, and this is something that we are committed to, which we said when we had raised the IPO money in the first year, we're gonna focus exclusively on executing our strategic projects, and then by the time we get into the second year, we'll be looking to diversify our footprint from outside of Jamaica. So all of that is work that is ongoing and has started already, but it's real estate, right? It's just, put down your head, execute, and it takes time. It's not like selling widgets where you can count how many customers come into the store each day. It's really project finance. And until you have exited a project, there's nothing much to say or do. And then you exit, big lump sum, and then you rinse and repeat, find the next project. Takes 18 months or however many long, depending on the type of project. Execute it, exit, and then you rinse and repeat. So it's kind of boring during the periods when there are no exits, but certainly when we get that new cash, the cash will go into new projects, brand new, and it will also, at the same time, finance projects that are in advanced stage of development as necessary, as needed.
All right, thanks very much for that, Jason. Thanks again as well, David. There's one more question I think it'll be a good question. I think I've counted it as the last one. A comment from Josemar Scott. He's just asking, outside of the cost of raw material, such as steel and lumber, do you see any other factor driving up development costs? And how will this affect demand for housing units? Counted that as our last question.
Sure. You want me to take it, Jason?
Yeah, you can take a stab at it. If I have anything, I'll add.
Sure. So that's a very good question, and it's and if I were to frame the answer around low-income housing, that perennial chase that we are trying to find a lot of low-income solutions in Jamaica, and it always seems to be a challenge. And some of the factors that help to keep the cost high relates to infrastructure. In the first instance, infrastructure, things that, for example, sewage. when you have to put a sewage plant into a housing scheme, that adds significant costs to the overall price of a unit. I myself live in a small complex with 17 units, and we have to have our own sewage plant. And what I'm saying there is when you have to layer on the cost of what should be general infrastructure onto the cost of a single unit in these developments, that is the type of thing that helps to push the cost up. So instead of just paying for the block and steel and the labor component of building a house, you're also layering on infrastructure costs onto a unit that ought not to be there. And I think the estimates are probably that between 15 to 20% of the cost of a unit tends to be for infrastructure that tends to be put in by a developer because they're not centralized. Sewage is a perfect example. I think another component of cost of real estate that we should look at is when it comes to the actual choice of materials. The big duopoly in this world, Airbus and Boeing, they moved away from metal airplanes and went to carbon fiber planes years ago. A huge shift from aluminum planes to carbon fiber planes, but look what it's done for them. And the same way with construction, we have all grown up with block and steel as the only material that we find acceptable. And maybe it's a chance for us to look at other potential material sources that will give us the same hurricane resistance and earthquake seismic protection, but at a far lower cost than having to lay the manpower it takes to lay concrete blocks. So just two examples I'm giving you there about how the cost of input impacts the cost of our development. Really, there is the infrastructure side of it, and then of course there is a material selection, and of course you have to look at the regulatory framework. So there are many different components that come into play when you're considering what drives the costs of a unit in the development. And what we do is to take the time to analyze each one to see how best we're able to optimize and unlock the value before we actually go and start a particular real estate project. So I know it's been long-winded, but I just wanted to give you a good sense about the many, many variables that are involved when you're thinking about doing a real estate development.
And that was very, very thorough. Much appreciated, David. So I'll take time now to say thanks, everyone. Thanks, Jason, Morris, and David Cummings for making themselves available for this earnings call. I want to thank all the listeners that came in both through Zoom and YouTube. The recording of this will be presented on the Signal's website, as well as our earnings call presentation and the report itself. The media management discussion and analysis will also be on the Signal's website. So feel free to go back to this recording after and just listen in again for this insight directly from the professionals themselves. And I know we continue to look forward to unlocking value for our shareholders within the Signal's Real Estate Finance. And we look forward to hearing you guys again at our next earnings call. Have a good evening, everyone, and stay safe.